So now that we've touched base on supply and demand, that leads us perfectly into order blocks. Now firstly, what I want to say is order blocks, or the term order blocks, originated from someone on YouTube. His name is ICT, which stands for the Inner Circle Trader. Now I haven't personally learned from him. I've just learned from other people and my own sort of research, but this is what he, I believe, invented, like the term order blocks. So you can go check his YouTube out, see his videos from years ago and his most recent videos. But yeah, I thought I would just make that clear because it's only fair, I'm teaching it. But this is how I'm going to be teaching it. Now there's a lot of information here, so definitely write some of this down, get a notepad, and let's get into it. So starting at top left, order blocks. So what are they? Well, an actual order block is the final candle before an impulsive move that leads to a break in market structure. This basically means the most recent higher high gets taken out, or the most recent lower low gets taken out. If a higher high or lower low is not made and price proceeds towards the upside or downside impulsively, then that final candle before that move is not considered a valid order block. Price must break structure to be valid. So an impulsive move up or down which doesn't break any significant market structure is not considered a valid order block. So when we take a look at supply and demand, or bullish and bearish order blocks, the newer is usually the better. So the fresher the order block, usually the better and more significant it is to us. So what I mean by this is an untested supply or an untested demand zone, i.e. order block, is more likely to give us the expected reaction that we're looking for with price, as opposed to one that price has already come into before to mitigate. We may not see that reaction we're looking for, or it's less likely we will. Now a quick rule of thumb, the 50% equilibrium point of a particular order block can act as a strong level where price likes to mitigate to before continuing in that overall direction. So basically the halfway point of that order block. What I've found to be true in my own testing is if price comes up to fill 50% of the order block, then we can classify that as mitigated, meaning it's completed and there's not much reason to look at that area for future interest. So if price comes up to reach 50% of a particular order block, we can class that as a completion of that mitigation. But it's definitely important that you do your own research on that and back test, because you may find it doesn't work as good for you. You may have different rules. Now, the time frame you're trading and the market structure you are currently seeing is important, meaning, are you seeing bullish market structure? If you are, then it would make more sense to be looking for long trades at demand zones and bullish order blocks, rather than looking for supply zones and shorting bearish order blocks. Now obviously the same concepts apply if you're seeing bearish market structure. So again, bullish market structure, so if we're putting in higher highs and higher lows, then it would make more sense for us to be looking for long trades at demand zones or bullish order blocks, rather than trying to short at supply zones. And then the same concepts flipped in reverse. If we're seeing bearish market structure, it would make more sense to be looking for supply zones and bearish order blocks as opposed to demand zones and bullish order blocks. Now usually speaking, the higher the time frame, the more significance of the zones and the order blocks will have, meaning they can be more reliable. So an example of this, taking a long from a 4-hour order block that leads to a £5,000 move or $5,000 could give more of a reaction from taking a long from, say, a 15-minute order block that led to only a £500 move or a $500 move. So I hope that makes sense. If not, make sure you're writing this down, because all of these points are, they're really important. Okay, so let me read that bit again. So taking a long from a 4-hour order block that led to, say, a £5,000 move could give more significance or more of a reaction from taking a long from a 15-minute order block that led to only a £500 move. Okay, so now order blocks. A bullish order block is the last down candle before a bullish impulsive move to the upside that breaks structure. We will see large momentum to the upside, which usually leaves behind some price imbalance. Not always, but it can leave behind price imbalance, and we will get into imbalance in upcoming videos, so don't worry about that. So again, this is important. A bullish order block is the last down candle before a bullish impulsive move to the upside, which breaks structure. This move would usually be with large momentum, leaving behind price imbalance. Now, order blocks are just a fancier word for supply and demand. They're pretty much the same thing, but we're just taking the one candle rather than that consolidation range. Now, these levels are where large institutions have placed big orders at these areas in the market. Now, the theory behind it is that price will eventually gravitate back towards these order blocks to rebalance price, fill any liquidity that couldn't be filled before as price moved aggressively away from that area, and for more orders to be placed, and then before continuing price to the upside. Once we get these order blocks form, they usually leave behind imbalance, as I just said. So price needs to usually return back and make price efficient before continuing to the upside. We can identify a clear entry and stop loss with order blocks. Entry at the top of the order block with a stop loss at or just below the order block. So if we look at this diagram here, this is a bullish order block. So this candle is the actual order block because the momentum came in on this next candle here, and this would have broken structure as well. So again, the theory is price will eventually gravitate back towards these order blocks to rebalance any of this liquidity or imbalance left, for more orders to be placed, and then for price to continue to the upside. Now, what we can do with these order blocks is we can set an entry. So once we impulsively move away, we can set an entry at the top of the order block, and our stop loss can be at the low of the order block, or we can put it just below if we have some wicks, or if you want to just account for a bit of spike in, you can put it a couple pips below, so price can tap in, rebalance price, and then continue to the upside. Now, a bearish order block is obviously in reverse, so it is the last candle before a bearish impulsive move to the downside that again breaks structure. So it's a bearish order block is the last up candle before a bearish impulsive move to the downside that breaks structure. We will see large momentum to the downside, which usually leaves behind some price imbalance. And again, as we covered here, large institutions have placed big orders in the markets at these areas. The theory is that price will eventually gravitate back towards these order blocks to rebalance price, fill any liquidity, and for more orders to be placed. So this is the order block. Price impulsively moved away, leaving behind imbalance and liquidity. Price needs to return back and make price efficient before continuing down. So we tap in, rebalance price, and then we continue to the downside. Now we can identify a clear entry, so we can enter with a limit order at the base of the order block. So we take the wick with a stop loss at the top of the order block, or we can account for spiking, so we can put it 2 pips above just to give us that leeway. So if price does come up to test this high, we'd be protected, and then we can see price continue down. Now, one thing we can do with order blocks is we can refine it down and see where that momentum has come into the market. Now, what I mean by this is if we had this as our order block, but we had a candle that followed this one and it didn't engulf the actual order block, what we can do is refine it down to that bullish candle rather than the last down move. So let's get into this now and show some examples. Order block refinement. So one thing we can do, as just discussed, is we can refine our order block down if possible. So it's important for us to note where the momentum has come into the market, i.e. where the institutions have got in. Because essentially what happens is wherever the momentum started, price will need to come back to that area, and then we can see price continue its move from there. The reason why refining our order blocks down is beneficial to us is because it tightens our area of interest, meaning we can get in more precise with a tighter stop loss and usually decrease our drawdown on our positions. It will also give us the chance to increase our risk to reward ratios on our trade so we can get a better return on investment. Now, the examples below show an order block refinement. So let's start on the bullish order block. So what we've got is this is the last down move before the up move. So this would be our order block. But you can see the candle we got that followed this one is here. And it's a bullish candle. But notice how it's not showing any momentum or any progression in the market. It hasn't engulfed this order block, meaning it hasn't closed above, showing that momentum. It was in fact the next candle that showed that momentum, engulfed this candle. So what we can do is we can take our order block, which is here. So this is the last down move, but we can actually take this as our order block because it's the candle before that momentum came in. So the ratio on this candle is 15 pips. Whereas if we would have kept to this order block, this is what we're looking at, 25 pips. So we're able to decrease our area of interest by 10 pips. So what that's going to do is basically get us in at a better price, a tighter stop loss, and less drawdown and more risk to reward on our trade, because we are able to decrease our stop loss size by 10 pips. Okay, so the next example is a bearish order block, which is exactly the same thing. This is our bearish order block, but the candle after did not show any momentum, or it did not engulf the order block. So we can take this as our order block, refine it down to this. So this is now our order block because it's the candle before that momentum came in. As you can see, this is large momentum. So we can refine it down. This is our order block, 15 pip stop loss, which is including the wick. So this is the wick. What we can do is put our stop loss at that wick or just above, giving ourselves a bit of room to breathe, as it's still 15 pips, whereas the original order block is 25 pips, as you can see here. So now we've covered that, I want to get into some examples on the charts, because I think you'll start to get it a bit more when you actually see it visually. So let's get into that now. Okay, so now we're going to go through some examples of order blocks and refinement. Now we're on the hourly time frame looking at Euro USD. So if we look at price action, we can see we was previously in this downtrend. So we was putting in lower lows and these lower highs. It's clear to see. Now we broke structure to the upside. So we broke this lower high here. We pulled back, impulsed up, breaking this high. So we can see a change in market structure. It's clear to see we're now bullish. So we're looking to now put in higher highs and higher lows. So once we broke structure, we broke structure here. So this lower high, we broke, we then pulled back, and we broke this lower high as well. So we're now seeing that change in momentum. So we want to be looking for, you know, potential longs. So if we look to see where the order block would be, so we pushed up, broke structure, pulled back. This is the last down move before the impulsive move up that broke structure. So this is the order block. So if I just zoom in a bit so you can see this. There we go. So last down move, but what we've learned already is we can refine this down. So the candle after this order block is here, and it hasn't engulfed this candle, meaning it hasn't shown momentum. So we can actually refine it down. And when we refine down order blocks, it won't always mean that the area of interest is tighter. It means we can be more precise. Usually it'll be tighter, but it won't always be tighter, because in this example here we have a wick, quite a large wick. So this is our order block, because again, price pull back, last down move, refined to this order block here, impulsive move up, we broke this structure. Okay, so BOS. BOS means break a structure. Okay, so that's clear to see, change in market shift. And once we impulsed away, we left some imbalance in price. Now basically what imbalance is when buyers or sellers take control, and, you know, sellers or buyers haven't got a chance to get involved. Now you can see the imbalance would be from this wick to this wick, because they're not meeting. So everything in here within these wicks is, you know, buying power, and, you know, zero sellers. So usually what that means is price will in the future come back to fill this imbalance that was left before potentially continuing to the upside. Now as we can see, once we impulsively moved away, price started to correct. We actually had equal lows on a lower time frame. We swept the equal lows, but you can see price didn't come back into our order block. But what did it do? Well, it come down to mitigate the majority, not all, but the majority of this imbalance before continuing. Now this will happen from time to time. We won't get a tap into the order block, but the reason being is because it's usually just rebalancing any liquidity or imbalance from just above the order block. So, okay, we didn't get tapped in, so, you know, we could have had an order here. Order would have been set at the top of the refined order block, stop loss at the base of the block, or as we've learned, we have a wick here, so we can account for that wick just above. So we've got a 12 pip stop loss, and we can set this entry as soon as we've broken structure here. Now you can see, if I get my measurement tool, we fell short of tapping our order by 6 pips. Now once we sort of broke up and we started to break these structures, we can cancel this order, because, you know, it's unlikely price will return back, because we have filled most of this imbalance, so price can move from here. So if we look at the next example, what have we got? Well, now we know that we've pushed off from here. This move up hasn't broken any structure. We just wicked sort of this high, forming these equal highs here, okay? So we can put that on. So equal highs basically means, you know, the same way you look at a double top, but there's liquidity above equal highs. So you get one high and two highs, equal highs in the name, so they're equal. Now they won't always be equal, like perfectly like this, but once we get this, it means that there's liquidity above from people who are shorting from here, known as a double top, or from people with buy stop orders looking to go long. So you can see price now impulsed up above the equal highs. Let me just put that on. So I put a dollar sign just so I know there's liquidity above. So now we've impulsed above, breaking the equal highs, taking liquidity. That leaves behind an order block, which is here. Okay, now let me just remove that. We can see we've broken structure, BOS, and you can also class this as a break of structure here because we have closed above the candle bodies, but you know, we had a large wick which is up here, which price hasn't got to, but we have had a break above candle bodies. Now we will get into market structure and mapping out, you know, your breaks of structure in that in a future video, but we can see that we have broken structure regardless, so this is an area of interest for us. Now this is our order block, so what we can do is place on an entry. Now we can't refine that down because this is the last down move and the candle after is when the momentum came in, so we can't actually refine it down like we did here. So we have got a large stop loss, but what we can do in this example is actually drop to a lower time frame and look to see if we can refine it down. But for the purpose of this video, I'm just going to go with this. Okay, so yeah, we've got our entry set. This is our trade. We've got our limit order on. So let's just see if price taps us in. So we get a wick, and we close, you know, with this large wick, and we then pull back quite aggressively. But what this essentially is price pulling back, rebalancing the inefficiency left on this move up, which you can see more clearly on a lower time frame. But we've mitigated, meaning, you know, a close of sell positions, stacking more buy positions. So the expectation now is for price to continue making higher highs. So we got tapped in, we got triggered into the trade here, stop loss just below this wick, and this is our trade, so we're in. So now we're expecting a push up, so we tap in again with that wick, we then push away, and eventually we start to make a new high. As you can see, we've broken this high here, broken structure, and if we was in this trade, what we can do at this point is, you know, we can place our stop loss at break even or just above. Oh, yep, stop loss at break even or just above to account for spreads, just like that. So now we're risk free on this position, or we can take partials on trades, but it's your preference. So let's see what we get. Now, as we have broken structure, would I be looking at this down move as an order block? Well, if we look at it, it would be a very large sort of order block. We can then refine it down to this candle. And for me in this example, I would use this candle, as these candles do show a bit of momentum. Not really, so we've got a bit of wicks, but you know, we did push off breaking structure. But notice how the wicks are meeting on each candle as opposed to here where they didn't. So this is showing me efficient price action, meaning price doesn't really need to come back down to mitigate because it's already efficient. So price could just pull back from here and go. So for that reason, I wouldn't be looking to get involved in a trade or look at this as an order block. But let's put it on just to, you know, for why not. And then we break structure with a wick and we push up. Corrective price action. But if we was in this trade from the bottom, we can look to, if this is going to work, we can look to lock in more profit, you know, at this low here, because we've broken a high, so we can manage under this low and lock in some profit. And we then push up. So this is what we was expecting. So we're now putting in these higher highs and these higher lows. But you know, price is corrective and it is efficient, so I wouldn't be looking to, you know, get involved in any sort of scaling trades. But what I would be doing now is moving my stop loss up to this new low just below it. So we've got around, you know, 1.4 locked in, but don't focus too much on the percentage. This is just showing the order blocks, because this trade here, we can get in with a much tighter stop loss utilizing the lower time frames. But for this video, we're just going to be looking at the concepts of order blocks, and yeah. Okay, so here you can see we've now shown large momentum as we see here and here. Okay, so we can look to get involved, but we need to break structure, and we have broken this structure here. It's definitely structure, because we did pull back. So let's mark it on BOS, break a structure. So let me just remove that because we don't need that. So where would the order block be? Here. Let me give you a second to see if you can see where the order block would be before I place it on. Okay, so firstly, take the last down move, which is this tiny candle, which is a doji candle. Then let's look at the next candle, which is this one. Doesn't really show too much at all. So I'll be looking for this as my POI, which means point of interest. This candle here, let me make this a different color, so you can see it, okay? So this is the candle that I would be using as my order block, because the candle next to it is the one that broke structure, and then we see momentum into the market, okay? So I can't quite remember what happens in price, so I'm just gonna, you know, set an entry and see what we get. Stop loss just above, just below the order block, 14 pips. And I'm gonna see what we get. Now the imbalance in this move would be from this wick to here. So again, notice how the wicks aren't meeting, so it's imbalance. So what we could see is price pull back to rebalance this imbalance and then continue to the outside. But you know, I don't know what happens next, so let's just see. Okay, so we've mitigated that imbalance, and we have this wick, we wicked above, closed below. We've now tapped in to our order block. So if we took this trade, we would be tagged in. So let's see what happens. Okay, so there we go. We tap in and we go. So I didn't actually know this was going to happen. But you know, this is just the power of order blocks. So price just moves based on order blocks. So when we're seeing bullish order flow, we push up, breaking structure to the left. We come back to mitigate that move and tap into the order block. Break a structure, mitigation, continuation, break a structure. You know, this is bullish order flow. Okay, so we're seeing break to structure, initiation, mitigation, continuation. If you can learn that in trading, then you know you're onto a winner. But from this first trade that we was in, we were set to break even once we broke structure. We then broke structure here, and then we moved our stop loss to the low, and then you know, keep repeating the process. So now we can move to this low here. I know it's a bit hard to see, but this is our stop loss from this first position. And you know, this position we can move to break even just above, because we have broken structure. Okay, so we broke structure here. BOS. So now we're seeing bullish order flow. Okay, so the expectation doesn't have to happen, but the expectation is either a push up, a push back, mitigate, continue, new high, break a structure, mitigate, continue. Now if we keep seeing this, and we want to keep seeing this, if we are to see price push down, excuse the drawing, but if we are to see price push down below this higher low, then the expectational order flow comes to an end, and we can see price start to sell off. But let's keep going and see what we get. Okay, so back to corrective price action, and we're pushing back now, so we're out for break even, and we're out of our next position, first position, sorry. So what I was saying, for us to see this continue, we don't want to see price come below the most recent higher low, which is here. If we see that, then it's showing us a change in market, a shift in market structure. So now what we can see is price either pull back, tap into a supply zone, as we have here, bearish order block, and then continue down. But that's going to do it for this example. I think I covered it pretty well. If you have any questions, let me know. And yeah, thank you everyone for watching.